Bitcoin just posted relentless $10,000 volatility swings. A textbook example of liquidity drying up and big money rotating behind the scenes. While many retail traders are glued to fear-based headlines, smarter players are positioning quietly. We just saw one of the deepest RSI oversold conditions in recent memory. Something that historically precedes periods of significant opportunity, not just noise. Today's volatility isn't random. It's symptomatic of a macro risk reset that's rippling through every corner of global markets, from US equities to crypto ETFs and derivatives desks. Is this action a dead cat bounce or the most undervalued entry point in a generation? After 10 years of watching every cycle from $2 to $126,000, I can tell you, this moment matters. Welcome to Preyo Promo, where we cut through the noise. Bitcoin peaked near $126,000 late last year and has since corrected sharply, losing almost half its value in just a matter of months as the macro risk narrative intensified. This drastic correction isn't simply a pullback. It's driven by macro conditions, ETF outflows, and systematic rotation out of risk assets. Right now, the technical structure is telling us something crucial. Bitcoin is technically oversold and emotion-driven, but that doesn't mean the bear market is over. Weekly RSI has plunged into historically rare oversold territory, the kind that usually aligns with relief rallies, not trend reversals. From a macro perspective, U.S. economic data, geopolitical pressures, and risk rotation in traditional markets are influencing crypto sentiment just as strongly as crypto-native flows. This means Bitcoin's crash has roots in traditional finance stress, not just internal crypto weakness. For the charts I'm watching closely, $84,000, a key multi-timeframe structural support, $70,000, $72,000, a psychological pivot zone, $60,000, the 200-week EMA support that has held in past cycles. Breaking below 84K would invalidate many near-term bullish setups. Holding 84K or reclaiming higher levels would signal a healthier base formation. Make no mistake, this action is relief rally territory, not trend reversal territory. Segment 2. Ethereum and the utility shift. Now let's move to the silver metal of crypto, Ethereum. Ethereum has been hit hard in this risk-off regime. It's recently shed significant cap, reflecting broader market stress, but it's also showing support structures forming at major multi-year zones. Right now, the key reality is that Ethereum isn't just a speculative asset. It's the backbone of decentralized finance, smart contracts, and the next generation of financial infrastructure. News like emerging institutional interest in Ethereum and expanding use cases suggests we're moving into what I call the Ethereum bottom zone. When ETH trades below key psychological levels like $2,000, even in the face of broader market weakness, that signals a potentially asymmetric long-term opportunity for risk capital. But make no mistake, outperforming here requires a strategic view. Instead of chasing price alone, we're watching fundamental utility adoption, decentralized finance growth, and institutional participation. Watch ETH BTC closely. When that ratio begins to rotate upward even while markets are weak, that's a leading signal of structural reallocation rather than mere speculation. Segment 3. The stablecoin contradiction. Tether versus the world. Here's a segment that rarely gets the spotlight, but it should. Stablecoins are the plumbing of every crypto rally and correction. Tether, USDT, the dominant stablecoin, is quietly shifting its reserve strategy toward gold and hard asset collateral to respond to regulatory stress and demand for safer backing. This is an institutional pivot, not retail noise. But that strategy is not without contradiction. As Tether moves into gold and hard assets, regulators globally, like in South Korea, are calling for stricter crypto frameworks in response to system vulnerabilities, not just market volatility. This tug-of-war creates liquidity tension in stablecoin ecosystems because capital can either flow to hard-backed stablecoins, regulated USDC variants, or away from them entirely in risk resets. For example, if gold-backed USDT gains confidence, it could pull liquidity out of mainstream trading venues into safety buckets, which shrinks risk capital pools. Conversely, failure could accelerate flight to regulated stablecoins and bolster institutional on-ramps. As a 10-year veteran, I see hedge playbooks rotating liquidity both ways. hedging for hard assets while holding regulated routes as primary corridors for capital. Segment 4. Institutional dominance. BlackRock, Citi, and the Fed. The noise about institutions leaving crypto is overwhelming. But let's look at the actual truth. BlackRock, under Larry Fink, has publicly reinforced crypto's role in the future of finance, especially as a diversification tool in large institutional portfolios. While money is rotating out temporarily due to risk aversion, the structural entry tracks remain intact. Citibank's analysts and macro strategists remain constructive on digital asset infrastructure despite volatility, emphasizing utility and diversification over short-term price swings. Add to that the evolving regulatory narrative, with frameworks like the Clarity Act gaining traction, and you see institutions preparing for lifecycle normalization rather than exit. This doesn't mean price goes straight up. It means capital allocation is strategic, not reactive. Here's the nuanced truth. Spot Bitcoin ETFs are now moving more capital daily than Bitcoin mining production. The ETF outflow episodes are signals of rotation, not abandonment. The market's resilience is increasingly tied to regulated integration, not unregulated speculation. Now imagine AI systems using Bitcoin as settlement layer, autonomously hedging, rebalancing, and allocating capital. This isn't science fiction. It's the next frontier of financial stack evolution for 2026 and beyond. Paul's pointers, the final verdict. So let's summarize with clarity, not hype. Gold and silver. Precious metals have outperformed recently as risk aversion surged. Many macro strategists now see gold strength as a precursor to broader risk asset reassessment. And sometimes, that leads to rotational inflows back into digital assets. Bitcoin buy zone. If price tests stronger support at multi-year lows like 60K or 56K structural bands, that could represent a laddered accumulation zone for long-term position builders. Sentiment. Fear metrics are extreme, but historically, extreme fear isn't a trend signal. It's a positioning reset. True bottoming patterns require multiple confirmations. Structural support holds, liquidity returns, and macro stabilization. Not just oversold oscillators. As someone who has navigated every cycle from 2013 through today, I respect the data, not the narratives. The market punishes panic and rewards patience. If you found value in this analysis and want data-driven crypto insights, hit subscribe for Preyo Promo and turn on notifications, so you can stay ahead of volatility, not behind it. So tell me, are you buying strength above 84K or waiting for deeper support near 56K? Drop your answer in the comments. I'll be reading and responding. Stay disciplined, stay strategic, and I'll see you in the next one.